Welcome, my Schedule C filing self-employed home buyer friends. This one's for you. Today's Tuesday tips, we're going to talk about what a lender will count and what will not count from your tax returns in your income when you're qualifying for a home. Last week, we talked about need for an excellent tax professional, and this week, we're going to learn why that's so important. Okay, here is your 2024 1040 Schedule C. This is used by sole proprietors and S Corps if there's only one owner of the S Corp. And so let's take a look at what parts count, what parts don't, what we add back in, and what we don't. So first off, most folks, when they're self-employed and you ask them for their income, I typically get told the number that's in line 7 here for gross income. However, we know that the business expenses that you paid were necessary to generate that income. So at that point, we can't count that line effectively. The line that we're going to be counting is line 31 down here, that is your net profit or loss. But we do get to add back in a few pieces. So let's talk about those right quick. Number one, we add back in your business use of home. Because in our application, we're already calculating your debt ratio based on your housing expense. We don't need to hit you for it a second time by taking it away from you in your taxes. So we're going to add it back in here because we're already counting it in the overall expense ratio of the loan. Second, we're going to add back in depreciation because depreciation is basically the overtime loss of value of assets that are owned by the company. So let's say you've got a fleet of trucks that are owned by the company. Well, over time, those trucks become less valuable. It doesn't mean that you shelled out new money to purchase them every year. It simply means that that value for those is less and less. So since that's not a paper loss, we're going to add it back in. Another one of those non-paper losses that we get to add back in is depletion. Now, this is very rarely used. You typically only get it with mining businesses. So if you've got a mining business, you have a limited amount of natural resource in that mine. As you sell off part of it, the overall value of the remaining mine is less and less over time, because there's a finite amount of resource there, okay? So that we're gonna let you write that off because you didn't actually spend money for that. It's just a cost of doing business that doesn't come out in dollars and pennies. It's an opportunity cost, okay? The next piece is that we will add back in your wages if they were paid to the owner. So wages that you pay yourself, because we don't specifically count the W-2, we add it back in here to give you credit for that income that you paid yourself throughout the year. Now, as a little bit of a downside, deductible meals, we're actually going to double that one, because we know that if you took a prospective employee or recruit out for a meal or a sales prospect out for a meal, not only did you have to buy the meal for that person that you were taking out, but you also had to buy the meal for yourself. And the IRS only lets you write off the portion you spent on purchasing a meal for another party. They don't let you write off the portion that you spent on yourself, but we know that that was also an expense, so we actually deduct both halves of that. So we're going to double line 24B. There are also a couple of items that we do get to add back in on the second page of the Schedule C, so let's talk about those right quick. So we get to add back in mileage. So we talked about depreciation on the first page. That's if the business owns the asset, but there are a lot of times, particularly with sole proprietors or small S Corps, where you have your personal vehicle, but you wind up using that for business and just writing off the business miles. Well, they won't let you add back in all of those business miles because part of that was spent on the expenses of gas and oil and maintenance. But they do let you add back in 30 cents a mile because that's the portion of the calculation that is attributed to the depreciation or the loss of value over time of your personal vehicle as a result of its business use. Okay, so we'll add that back in. We will also add back in amortization because that's once again one of those paper losses that did not involve dollars leaving your pocket or your company's pocket. And we'll add back in casualty, theft and loss, and extraordinary one-time expenses. So these are things that only happen once. They're extremely rare to happen. So perhaps a natural disaster and you had to pay the deductible on your insurance to get your business facility back to an operational state. Or let's say you had an event of employee embezzlement that you lost money there. They're not anticipating you're going to keep that employee on your payroll. They're anticipating they're going to come off your payroll, and that's no longer going to be a loss that you're sustaining in future years. So we add those back in because those aren't things that need to be taken out of your income on a regular basis. It was a one-time, just unusual event. It was an anomaly. So we're going to add those back in. Now that we've talked about what counts and what doesn't, let's take a look at a sample income calculation so you can actually see it in action. Here we have the actual tool that we use with a Fannie Mae 30-year fixed conventional mortgage when we're calculating income. So I set up a fictitious set of tax returns, just an example, that had $250,000 in gross receipts, $10,000 in other income, so $260,000. I put in various different deductions, and then I got a bottom line number, a total net profit of $100,000 on here. So let's take a look at how this actually shows in our calculator that we are using. So first off, we see our net profit and loss, and you can see here that is line 31 like we talked about, and that comes out at $100,000 on the tax returns. And that's what we're using on the income calculation. We did have other income that I had plugged in of $10,000, but because I only have 1 year of taxes and not two, it is not counting that $10,000. We would need 2-year history of whatever that other income is in order to count it. So you can see it's here on the tax returns, but it was taken out of the lender calculation. Now, depletion I did not use because once again, it's exceptionally rare. Depreciation I did use, and I stated that we had $25,000 in depreciation of business assets. And you can see that $25,000 is actually added back in here. Vehicle depreciation, I did also state that there were 25,000 miles. That's counted at 30 cents a mile. So we added back in that $7,500. I also put down that we had $1,500 in deductible meals and $1,500 in non-deductible meals. So that's the other half of the 2-meal piece. And you can see this shows as a negative because it's taking that additional $1,500 back away from the income calculation. Now we've got our business use of home at $53,500, and you can see that added back in. Amortization at $10,000, you can see that added back in. Casualty, theft and loss, and extraordinary one-time expense I did not use. And so you can see here how that comes in. I also did pay the business owner in the tax returns $10,000 in W-2 wages, and those are also added back in. And that gives a usable income out of that $260,000 that showed as the top line. With all our adds back in and our deductions, we can see that there's $204,500 that is usable income that would be able to be used to qualify for a home. So as you can see here, self-employed income taxes can be incredibly complex even for a relatively small business. So it is critically important that you've got a tax professional that understands how to work with your lender to make sure that you're qualifying for the home you want. Number two, it's also critically important to find a lender who understands how those taxes are going to be calculated by the underwriter and can make sure that when you're getting a pre-approval letter to go shop for that home that you want, that the income that's being used is true and correct and real based on what the underwriter is going to count in the end of the transaction. Because the last thing you want to do is go out there shopping for a home when you've been told you can qualify for this much, and then you get under contract for that home and everything goes into the underwriter and the underwriter says, oh no, that was a miscalculation. You can only qualify for this much. You don't want to be in that position and have something happen to your contract when you've already gotten your heart set on that property. So make sure you are choosing both your lending professional and your tax professional well. If you have any questions, please put them in the comments. If you found this information valuable, please like and subscribe and can see me again for your next installment of Tuesday Tips. Have a great day.